So what exactly is a term sheet and why is it such a big deal? Think of it as the blueprint for your investment deal, outlining all the key conditions before you dive into the binding agreements. Today, we've got a standard term sheet template that we'll walk you through. Pay attention. Understanding this document is a game changer. First, you'll see a reference to the type of security in the transaction. There can be many different structures to an investment, but today we focus on 3 of the most common, which are investments via the issuance of preferred stock, simple agreements of future equity, or so-called SAFEs, and convertible notes. Let's start with issuance of preferred stock in what's called an equity investment or priced round. Investors give you money and in exchange take a certain ownership in your company, represented with shares. These shares come along with a series of rights for the shareholders of that class of stock. You will see these in most fundraising rounds, except at the early stages where SAFEs tend to be the standard. SAFEs allow investors to convert the investment into equity at a future date. The investor gives you the money now, and once you raise your next priced round, the investor is entitled to shares. What's the point of this? In a normal equity round, since the shares come along with a lot of rights and the rounds tend to be bigger, there is a lot of negotiating. You have to get lawyers involved, and all of this is very costly. Back in 2013, Y Combinator came up with a structure because it's simple, fast, and cheap for early stage companies. They want to raise capital but don't want to deal with the headache of an equity round. In a SAFE, no shares are issued or sold, just the promise that an investor will receive shares when an equity round happens. It's basically deferring the work of negotiating these shares to a later date once you have another investor who can lead that charge. We see this a lot in pre-seed rounds and seed rounds. Third, we have convertible notes. It's similar to a SAFE, but it has an interest that accrues. So if an investor invests 10 million with a 10% interest rate, in a year that would be worth 11 million. And if at that point you raise an equity round, the ownership stake would be calculated of that 11 million, not the 10 million that was invested. It's a debt instrument that converts into equity, and investors like it because it helps prevent downside risks with the debt while preserving the upside of equity. So which one should you use? If you can get a SAFE, go ahead, especially in the early stages. You'll typically find that as you grow, a normal equity round is going to be more common. When macro conditions are rough and it's tough for startups to raise capital, you see a lot of investors pushing convertible notes because it minimizes their risk. Next, you'll have the investment amount and valuation. Notice that here it says post-money valuation, including an available option pool equal to X% of the post-closing fully diluted capitalization. A few things here. What is valuation? What's an option pool? What does a fully diluted capitalization even mean? Valuation, valuation, valuation. This is what everybody cares about. How much is your startup worth? You have 2 types, pre-money and post-money. Pre-money is your valuation today. Say your company is worth 8 million. You have a co-founder and you own 50-50. So each of your stakes is worth 4 million. Say you're raising $2 million in a normal equity round. Your post-money is just your pre-money of 8 million plus 2 million investment from the round. Now your investor owns 2 million out of the 10 million and you and your co-founder own 4 million respectively, or 40% of the 10 million. You own 50%, now you own 40%. This is called dilution. Your change was from 50% to 40%, which is a 20% difference of the total shares. If you were to imagine you raise at a higher valuation, then your stake is worth more and you get diluted less, which means you retain more ownership. If you change the valuation to pre-money of 18 million and raise $2 million, you retain 45% instead of 40%. That's why valuation is critical. A lot of things will impact valuation. Typically for startups in later stages, the valuation is based off a multiple, either revenue or more common nowadays, gross profit or EBITDA multiples, which are highly influenced by market cycles. However, what if your startup barely has revenue or has even no revenue? Broadly speaking, you base valuation based on the target dilution, typically around 20%. So if I want to raise 2 million at 20% dilution, my implicit post-money is $10 million. So pre-money would be $8 million. While raising at a higher valuation is generally the goal, it has some downsides. You want to give investors meaningful stakes so they're involved in the company and will support you in your follow-on rounds. If you raise at too high of a valuation, you will have a lot of pressure of living up to those valuation expectations. So you need to slam the gas pedal to grow, even when it may not be the best move for your company. And it will also affect your ability to attract talent because it affects the employee stock options. Think about it like this. Employees get options that come with a strike price as part of their compensation. The higher the valuation, the higher the strike price of these options, which reduces their value as employees would need to purchase the company stock at a higher price to exercise the options. These options are defined in employee stock option plans or ESOPs, which basically set aside a certain ownership of the company for your employees to motivate them. When you raise a round, you can increase the option pool, but sometimes that will be factored into your valuation already. The earlier you are, the higher the ESOP. At the seed round, it's typically around 10%. Note that these options are not shares. They are just instruments that one day can be exercised into shares. When you take that into account, we call it the fully diluted capitalization. Think of it as the total number of shares of your company once we account for all options and all shares. And we track these on the cap table, which is just a record of all the owners of a company. Liquidation preference basically defines if your company gets liquidated, who gets the leftovers first. Typically, a 1x, typically called non-participating, liquidation preference is common. That means that holders of preferred shares are entitled to receive up to 1x their money back first before the common shareholders. That's super important for you as a founder because you will have common shares, which are junior to preferred shares. So if your investors invested $100 million throughout the life of your company and it gets liquidated for, let's say, 20 million, the entire 20 million would be split amongst the preferred shareholders and you, the founder, would be left with nothing. There can be more complexities to this, including rules on which investors get first dibs, whether everyone gets in proportion, pari passu, or the most recent investor gets served before the last recent. So your Series C investors get paid out before your Series B investors, who in turn get paid out before the Series A. Sometimes you see investors push for a higher liquidation preference if they perceive a higher downside risk to you. Just be aware of the implications. Next up, founder vesting. Founder vesting puts limits on how much of your shares you get right away. That means that the shares you get are earned over time. Usually, founder stock vests over 4 years with a 1-year cliff and monthly vesting after that. It's a way to ensure commitment, meaning if your co-founder leaves after 2 years, he will only keep 50% of his stake and not 100% since he's not continuing in the business while you are. If he leaves even before 1 year, say after 6 months, he will not get any shares. Next comes the drag-along right, by which minority investors can be obligated to vote in the same way as the majority on a particular issue, typically a liquidity event. This is standard. It allows to get decisions done and not be blocked by a small shareholder as you're marching forward. Next up, conversion to common stock. This means that once the company IPOs or whenever the majority of the preferred shareholders decide, the investors' preferred stock will change to common stock on a 1:1 ratio, which would mean these shares lose all their special privileges. This is pretty common since preferred stock converts into common at the IPO anyways. This is also when IPO is so interesting for founders who are typically sitting in the common, meaning they are most junior in the cap table prior to an IPO. You may also find terms regarding governance, such as board rights for the new investor and how many board seats they get. Depending on the round and investment amount, it's typical to see 1 board director seat for the lead investor. Last up, exclusivity. It details how much time both parties have to bring the deal over the finish line and intends to restrict shopping around and soliciting other offers. 30 to 60 days is what you'll typically see. Look guys, we've covered a ton of ground here. JP Morgan always said, tell me your price and I'll tell you my terms. Knowing these terms and what they mean for you will help you land the best deal. Keep moving and improving. That's it for today. Thanks for watching. If you found this valuable, please share it with others that may benefit from it. Make sure to like and subscribe to our channel, and I'll see you soon in LATAM.